why don't we go ahead and jump into the presentation? And I think it's time to get started with the proverbial risk disclosure. So we don't need to read every word of this out loud, but do take a moment to read what's on your screen. And I think the key element here is that there is risk of loss in trading futures and options, or really with any investment. Past performance is no guarantee of future results, and that all funds committed should be purely risk capital. It's time to get a little bit deeper with options on futures contracts. Now, with futures options, one futures option equals one futures contract. And remember, these contracts trade in standard sizes. For example, here you can see corn at 5,000 bushels and crude oil at 1,000 barrels. The E-mini S&P 500 is at $50 times the value of the index, and gold is 100 ounces. So these are just examples. You don't need to really memorize anything about this. So what about options expiration? Well, with commodity futures options, many expire in the month prior to the underlying futures contract. So a May 2019 gold option would expire the third Friday in April. And that is just something to keep in mind. But remember, all options are going to have a different expiration depending on what market you're trading. So let's look at an example of a gold futures call option. Let's say Feb Gold's at 1226.40, and you were to buy a Feb Gold 1250 call at 1140. So 1250 is the strike price, 1140 is the premium. So just looking here, simply put, we're going to be buying one February gold, 1250 call, pay 1140 per ounce, and therefore it's has no intrinsic value, and the premium is all time value. And why is that? Well, the strike price is 1250. You have the right to buy at 1250. However, it's trading at 1226, so you wouldn't exercise your right to buy at a higher price compared to where you could buy it now. And here's what this might look like, and I'm going to get my highlighter here and point out something. Here's a typical order. So buying one, this is the symbol for February gold. Call, here's the strike price 1250, the price of 1140, and here's something called the delta. And let's keep that in mind as we move forward. We're going to really analyze delta in a bit here. But in this case, let's just make note that it's 35% approximately. All right, very good. What about a gold put? Here's a 1200 strike price put trading at 740, buying a February gold, 1200 put, premium is 740, intrinsic value is 0, therefore it's all time value. And it has no intrinsic value because a put is the right to sell, in this case go short. So you wouldn't go short gold at 1200 and exercise that option when gold's trading at a higher price, because you could sell it right at the moment at a higher price of 1226. And then here we go. Here's what that order would look like. Buying a Feb gold put 1200 at 740, and here's the delta on the put of about 25%. And again, we're going to get to that in just a second.